Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Well, dear listener of mine, this is it, our last episode of 2019. And what a year it's been. You know, the stock market up like 27% or so here. Still 12 trillion of negative yielding bonds in the world. U.S. House of Representatives is trying to impeach the president. It would only be the third time in our history. And, I mean, it's been a little crazy. $120,000 bananas. I mean, this guy that we talked about last time who's saying, buy it all, buy it. There's no such thing as risk in stocks. It's getting a little weird. Great year in stocks, a little weird overall. Now, it would be sort of typical to do a look back at 2019, right? The typical thing. I don't want to take the typical look back at the markets. Anybody can look back at what happened in various price movements in markets and make up a reason why and tell you what it means. But, you know, it's all backward looking. We know where we are. I mean, I've certainly talked about it to death. You know, and it's a kind of a typical, mostly useless sort of an exercise, although there are a few sort of annual looks back that are kind of valuable to me. One is by a guy named Dave Collum, who you can find on Twitter at Dave B. Collum, Collum. And he publishes a nice look back. So, you know, go read his look back and just leave it at that. And, you know, then there will be a zillion more looks forward to 2020. And it's all kind of a useless exercise because what happened. What's going to happen, nobody knows. So what should we do instead? Well, this week, I will look back, but I'll look back at all the non-investment topics we looked at this year, which we got a lot of great feedback on, I have to say. People really enjoyed this stuff because all of that stuff is probably much more timeless. It can help you not only become a better investor, but also become a better person, hopefully a happier person. And yes, you know, hopefully a wealthier one too, right? We spoke with a lot of guests who dealt with a lot of different sort of general life wisdom topics. And how fitting that the first one of 2019 was Shane Parrish from the Farnham Street website, who we spoke with during episode 84, published on January the 10th. Among other titles, Shane is the wisdom seeker of Farnham Street, a website he started anonymously while working for an intelligence agency. We spoke with Shane about a variety of topics, the most important one in my mind being mental models, the mental toolkit we use to understand the world. Shane lists 113 mental models on his website. I'd say that makes him an expert on mental models, okay? And he came out with a book this year called The Great Mental Models, Volume 1, General Thinking Concepts. It's the first volume in a 5-volume series that they intend to do at Farnham Street. I have it on my shelf. It's a highly readable resource that deals with 9 general thinking sort of mental models. The very first chapter is called The Map is Not the Territory. That's the first mental model he discusses. So the map is not the territory. It sort of explains itself quite well, doesn't it? The model you have in your head is not reality. And what a perfect first model to start off with in the book series that he's doing. And I sure wish the folks modeling risk in mortgage securities had taken heed of this back before the financial crisis, right? If they had, we might have avoided the crisis. And other things too, you know, like long-term capital management. They were modeling bond markets in a certain way, and they didn't behave that way, and they blew the heck up. Shane says his work is about learning about the world in a multidisciplinary way. It's about applied thinking. Thinking about thinking is what he told us. I highly recommend his book, his website, his work. It's a great way to learn to think about the world. And by all means, check out that episode. The very next episode after that one with Shane Parrish was episode 85, published on January 18th. That's when we interviewed Aaron Adelheit. Aaron is an entrepreneur and investor who wrote a book called The Hard Break, The Case for a 24/6 Lifestyle, which advocates taking 1 day a week off from work, email, and smartphones to be more productive and healthier, more creative, and have a more satisfying, happy life. I read this book and I decided that I would not work on Saturdays anymore. When you work at home like I do, you get into this rut where you feel guilty if you're not always working every single day of the week, because your work is always just a few steps away. And it's kind of beckoning to you all the time. But that's really unhealthy. So I decided I'd just take 1 day every week, and Saturday is it. And I've stuck to it. And it's made me not less productive, but more productive. I know that no matter what, I'm always going to honor my need for a hard break, for a day of rest once a week. So, I can really push harder on the other days. I also try not to work past 5 o'clock, but that's harder. I get up at 5 in the morning and I try to work no later than 7. So 5 p.m., that's, a 10-hour day. That ought to be enough. If it's not enough, maybe I should do something else for a living, huh? Aaron talked about his own struggle with being a workaholic, which really messed up his health, wound up in the hospital, messed up his relationships. He talked about how stressed out he was because his fund was down just 5% in 2003, the year the dot-com bust bottomed out. He also talked about how he started buying rental homes after the housing bubble blew up, including 1 year when he individually bought 2,000 homes. I mean, that's a lot of homes. That's like, what, more than 5 a day or something? It's ridiculous. So, yeah, workaholic. And our conversation just led us into all kinds of areas. For example, we talked about a phenomenon called the Zeigarnik Effect. Aaron said, quote, "It's from Bluma Zeigarnik, a Soviet psychologist who noticed that waiters could immediately remember unfinished orders, but had trouble remembering completed orders in a restaurant. And this has been duplicated a number of times. And if you think about the modern email and the tasks, they're always unfinished tasks. So this is part of that whir of technology, of email, of notifications. And there's constantly someone to reach out to respond to, something to do. And that's why you're always on the phone. And that's why it's so exhausting," end quote. On the flip side of that, I have to interject here. A similar effect is discussed in a book I recommended called How We Learn by Benedict Carey. And Carey notes that when you're practicing your violin or your piano or studying for your test or doing work or whatever, you should stop when everything is clicking and you're all warmed up, not after you feel like you've done everything you wanted to do. You cut yourself off to get that Zeigarnik effect of not having finished, and it helps you remember, and it keeps it alive in your memory. And much of learning is just remembering. So my point is, this Zeigarnik effect Aaron described is a double-edged sword, but I think you can manage it to your advantage. Aaron's got a great story. I strongly encourage you to read all about him in his book, The Hard Break, which is one of the few titles I keep right here on my desk. I've got about, 800 books in the office here now, I think. And I've got just like maybe 35 or so that I keep on the desk at all time at arm's length. And The Hard Break is one of them. All right, so next we published episode 103 on May 23rd. It's called How to Succeed in the Stock Market and in Life. And in this episode, I discussed one of the most important of these mental models like we covered in Shane Parrish's episode and like he covers in his book. And it's called Circle of Competence. This is what I said. It's called Circle of Competence. This idea was created by Warren Buffett as a way to help investors stay out of investments they don't understand. Now, imagine a circle with a smaller circle inside of it. The bigger outer circle, that's what you think you know. The inner circle is what you really know. It's a subset of that bigger thing. That's your true circle of competence, what you really know. That's what I said on the episode. So circle of competence is a great way to reflect on what your real strengths and skills and talents are and what your limits are too, right? That's what that circle is. It's a limit around your real talents and strengths. And I've struggled with this my whole life. I used to always want to do more than I could realistically expect to do. And I was always saying, yeah, let's do it. Let's do more. And, things pile up and they don't work out the way you want. One example of how I've improved on this is with my interest in music. I'd love to play everything, classical, jazz, rock, blues, show tune, standards, just everything. But I'm really best at classical guitar. That's what I studied in college. I've been doing it for 40 years now, over 40 years. And not many people are really very good at it. And at this point in my life, I'm playing pretty well, and I can play stuff that nobody I know personally these days could ever hope to play. It's been a long time since I hung out with lots of classical guitar players, so I'm sure, I could quickly change things so that I'd no longer be the best classical guitarist I know. But the point is, my current circle of musical acquaintances, it's a random enough sample of musical humans, and none of them are really good classical players. So, that kind of lets me stand out a little bit. And let's face it, most people who play the guitar are not like a really good classical player. So I just feel like it's something I have to keep doing. And because of that, I've gotten better at it. So I thought, if this thing is, most guitar players don't bother with it, that's pretty cool, right? So I focus on that. And wouldn't you know it, it's helped me with those other styles because I always cheat a little. I go into the next room, pick up my electric guitar every now and then and play some jazz and stuff. So I can still dabble in those other things primarily because I pay less attention to them and the most attention to the one most suited to me, which also just happens to be the most demanding one technically, allowing me to pick up techniques in other disciplines much faster. So by giving up those other disciplines as a primary focus, I actually got better at them. A totally unexpected and fortuitous outcome resulting from me trying to figure out what my true circle of competence is and trying to stay within the limits where I'm most effective. I think good mental models are like that. They lead to these nonlinear effects, which is mostly a fancy way of saying you never know how they're going to benefit you. The unintended favorable consequences that practicing a good mental model can provide. There's also this other book that I discussed this year and recommended you read called Models Behaving Badly by Emmanuel Derman, D-E-R-M-A-N, a physicist working as a Wall Street quantitative analyst. Among other things, the book teaches you the difference between models and full-blown theories. Derman writes, quote, "Theories offer us the most successful and accurate way to describe the physical world. They are deep and difficult to discover. They require verification, but no explanation. They are right when they are right. Models, however, live in the shallows and are easier to find. They require explanation as well as verification. We need both types of understanding," end quote. I think that's really cool that we need both types of understanding. And so you need to learn about theories and models, including these mental models. He's talking about like computer models and things, but they have the same, they're the same rough thing as the mental models we're talking about because they just kind of approximate reality and they're easier to find than theories. You get it? That's pretty neat. So one financial thing that I do want to sort of point you back to is episode 106, published on June 13th, where I talked about the basic mechanics of how to value a business. I think this was the most concise explanation I've ever given of the basic idea behind the valuation work we do in the Extreme Value newsletter, published by Stansberry, of course, which I write with a guy named Mike Barrett, who does some really good work. And that work that we do there, it's unlike anything done by any other publication at Stansberry. We do real deep bottom-up valuation work. What most other people do is like relative valuation. They do a kind of pricing where they say, the PE of this company is 10, the PE of all the other companies in this space is 20, this one has some upside, like that. We don't really do that. We assess bottom-up valuation in a completely different way, which I think is really valuable. I think you have to learn to do something like it to be effective in the stock market. All right, next, in episodes 111 and 112, episode 111, we spoke with poker champ and author Annie Duke, who wrote a book called Thinking in Bets. And then in episode 112, we spoke with someone who's actually a friend of hers, Michael Mauboussin, who wrote a few good books too, one of which is called The Success Equation, Untangling Skill and Luck in Business, Sports, and Investing. And Mauboussin gave us a little tip on how to figure out if there's skill involved in a particular activity instead of just luck. He said, you just ask yourself if it's possible to fail on purpose. With roulette or slot machines, it's impossible to fail on purpose, right? It's luck. It's pure luck. There's no skill. You can't fail on purpose. With basketball and tennis and other sports, as just, one kind of example, it is possible to fail on purpose. It doesn't mean luck isn't involved in those sports. It just means there's plenty of skill involved as well. And Mauboussin did definitely affirm that with investing, it's better to be smart than lucky because over time, investing skill will win out, even if you're unlucky sometimes. That was the good news that we got from him. And Annie Duke dealt with some of those same issues, like when she taught us how the great hand that you might be playing in a game of poker has no bearing on the quality of the decisions you'll make about it. So the game involves some luck because if you're dealt a fantastic hand, it's better than being dealt a garbage hand, for sure. But real success depends on your ability to make decisions, and that's a real skill you can learn. If you recall our interview with Annie Duke, she also came from a really competitive family, and I'm sure that didn't hurt her either, okay? So there's lots involved here. But that intersection of skill and luck, they both talked about it, and it was really, really an interesting and I think valuable conversation. Okay, in episode 123, published October 10th, I recorded the show in Las Vegas during the annual Stansberry Conference. And in that episode, I really did like a podcast version of the presentation I had done there, which really covers a lot of my overall views on stock and bond markets and has a few funny bits in it that I think you'll enjoy too. For example, I did my impression of the now former European Central Bank President, Mario Draghi, and I did my impression of these two German bankers. So if you want to laugh, go back and listen to episode 123. And then in episode 130, published on November 27th, I talked about Henry Singleton, an iconic investor and businessman, and we talked about share repurchases, which has become a very important topic today. And you can go back and read the transcript, listen to the episode, but the main point was that Singleton pioneered share repurchases and later in his career noticed everyone was doing them. So he said at the time, that must mean there's something wrong with it. And he was right. Nobody does share repurchases as well as he did it with his sense of discipline. He issued stock, which is really like selling it, when his company's shares were super expensive, and he used the shares to acquire cash flow positive businesses. Then when the bear market came, he used those ample cash flows to repurchase 90% of his company's stock, which made the shares soar into the stratosphere and created a huge multi-bagger return. And just overall, though, it's one of the most brilliant careers in all of finance, and it's something you ought to know about. That intersection of like the businessman and the investor. And there's a lot of other kind of life lessons in it for you. And a pretty good account of Singleton's career in that is in a book called The Outsiders by William Thorndike. And that book has great chapters on 7 other brilliant investor CEOs besides Singleton, including people like Tom Murphy, Katharine Graham, Warren Buffett, and John Malone, and others you might not have heard of, but also deserve your attention, like Bill Stieritz of Ralston Purina and Dick Smith of General Cinema. And like I said, it's a book about investing, but it's a book about business thinking too. So it's pretty cool. Okay, and one more really important thing now. Looking back over the year, my favorite interview of the year was definitely episode 108, published June 27th. The guest was Albert Laszlo Barabasi. And he wrote that book called The Formula, The Universal Laws of Success. And as I said during that interview, I read a lot of self-help books when I was young, just trying to figure things out like everybody else. But I wish I'd not done any of that. I wish I'd had Barabasi's book, The Formula, instead, because his work has a solid scientific underpinning rooted in math and science of networks, which itself is rooted in something called graph theory that, I don't know anything about. And we had a wonderful conversation, which I think is really super valuable to you. And so, we want to replay this interview for you. I hope you enjoy it as much as I enjoyed doing it. We got a lot of great feedback. So I expect if you didn't get a chance to hear it the first time, you'll want to hear it now. And if you did hear it the first time, listen to it again, man. It's that valuable. So without further ado, let's replay our wonderful interview with Albert Laszlo Barabasi right now.
Hi, this is Porter Stansberry. About 20 years ago, I set out to change financial services forever by creating Stansberry Research, providing our customers with high-quality investment ideas at a very low price. Today, I'm trying to change men's shaving in the same way. I've built the world's best razor. It's called One Blade. It uses the world's highest quality Japanese steel. It has all kinds of different innovations to make sure that you get a barber shop straight razor quality shave at home safely with every shave every morning. I urge you to try our product. Our core razor starts at only $19. And for a limited time, all Stansberry Research listeners can also get 25% off store-wide. Just go to www.onebladeshave.com/Stansberry. Try our product. You'll be glad you did.
Today's guest is Albert Laszlo Barabasi. He's the Robert Gray Dodge Professor of Network Science and a Distinguished University Professor at Northeastern University, where he directs the Center for Complex Network Research and holds appointments in the Department of Medicine at Harvard Medical School and the Central European University in Budapest. A native of Transylvania, Romania, he received his master's in theoretical physics at the, forgive me for the pronunciation, Eötvös University in Budapest, Hungary, and a PhD at Boston University. Barabasi is the author of Bursts, The Hidden Pattern Behind Everything We Do, Linked, The New Science of Networks. He is also the author of Network Science and the co-editor of The Structure and Dynamics of Networks and Network Medicine. The titles have been translated into more than 15 different languages. His work has led to many breakthroughs, including the discovery of scale-free networks, which continues to make him one of the most cited scientists today. Laszlo, welcome to the program. Thank you for being here.
It's a pleasure to be with you. Thanks for inviting me.
So, Laszlo, the first thing we need to do is, you're not our usual type of guest. We usually have people who manage money for a living. So let's just talk about what you do as a network scientist. My wife said networks, people networks or computer networks? And it's all networks, right?
All of the above. So network science is a discipline that was born about 20 years ago that tries to develop a language to think about all kind of networks that pervade our life. And, this is kind of grew out from the realization that just about everything we do through networks. We communicate through networks. Our friendships and professional links can be really perceived as a network and have to be perceived as a network. Our business ties are there. But even our very biological existence is made possible by the intricate metabolic and genetic networks within our cells. And about 20 years ago, a movement has started in science to quantify these networks. And hence, today I'm a network scientist who studies all of these networks and many more.
Okay. Now, I want to talk mostly about your book, The Formula, which I could not put down. I think it's an excellent book. And the first question I have for you is, you said a couple of times in here how the book is about the laws of success. It's called The Formula, The Universal Laws of Success. Are we really talking about like the law of gravity type laws? I mean, that's what you say in the book. It's really that kind of a law?
I tend to think it is. These are patterns that we extracted by studying the career of millions of individuals. And if you are in the right conditions of your career, we think you cannot avoid that. Hence, they really elevate at the level of laws. Now, not all laws always apply to us. As I'm walking around talking with you, Bernoulli's law doesn't apply to me, but if I start to fly, which is a gas law, then suddenly the only reason the airplane can fly with me is because the Bernoulli's law applied to us. So fundamentally, when these laws apply to you depends on the circumstances you find yourself in, but these are very generic patterns that apply to all individuals at that stage of their career.
Is it accurate to say that you basically study anything that behaves like a network, and the phenomenon of success among human beings is a very scientifically hard version of that? Success is a science, a real science.
Well, we certainly would like to think so. And the reason why I got into this is that much of the studies that we've been doing over 20 years focused on how the network looks like, how it evolves in time, and so on. And about 10 years ago, we started to think of a complementary problem. Okay, I'm a node in the network. How does this node affect my success? Does it help me? Does it pull me back? And whether my position in the network will really determine my long-term success. So we went after this question, and then we realized that if we want to answer it, we need to step back and address much deeper questions, like what is success? What is performance? How do they relate to that?
Yeah, so let's talk about the difference between performance and success. You gave great examples of performance with tennis players and golf. Who'd you talk about? Roger Federer and Tiger Woods. They're examples of great performance, right?
So what is interesting is that as we grow up, one of the things we learn in school and on the running field and everywhere else where we go is that you need to have performance to have success. And in a way that performance really drives success. So the question is, what's the difference between them? Because in our vocabulary, we often use it interchangeably, thanks to this strong belief of the relationship between them. And from a data perspective, since I'm a network and data scientist, we have to be able to distinguish them. So our approach was relatively simple and straightforward. Performance is what you do, how fast you run, what kind of deals you put together, how do you invest your money, what kind of paintings you paint. However, success is what does the community notice from that performance, whether it acknowledges it, and whether it rewards you for that. In other terms, your performance is about you, but your success is about us. We as a community reward you with success for your performance. And from a data perspective, that's a very important distinction because as we'll see during this discussion, as I discussed in the formula, in many areas, performance is very difficult to measure at the individual level. But success, because it's a collective quantity, it's easily measurable because there are multiple data points around you that pertain to your success. So measuring success and characterizing success becomes a big data problem.
So let's talk about a concrete example. Let's talk about the difference between, Tiger Woods and Roger Federer versus the artists you mentioned in your book, Diaz and Basquiat. What's the difference?
Sports is a very special area and kind of unique in terms of human performance because in sports, we have very accurate measure of performance. If you are a runner, I have a chronometer and I can measure your speed, and your speed uniquely determines how well you are regarded as a runner. And indeed, we actually ended up analyzing the tennis players like Roger Federer and all men and women tennis players' performance, how well they do on the field, as well as their success in terms of how many people actually follow them, how many people visit their Wikipedia page, how many people search for them on Google, and so on. And what we found is that in those cases, performance uniquely determines success. That we were able to actually build a formula that if I plugged in where did Federer play last week, against whom, and whether he lost or won, that formula tells me uniquely how many people went and visited his Wikipedia page. So starting from a performance measure, we were able to very accurately predict a success measure, which is curiosity about the particular player. But as I said, this is unique to sports, because in sports we have chronometers, we have accurate measures of performance. Most of us, however, live and work in areas where performance is much harder to gauge. And this is not to say that you can distinguish the good from bad, but there are actually many individuals with kind of comparable performance. Now, coming back to your question, sports is one area where performance can be very accurately measured. The other extreme, where performance is inherently impossible to measure, is arts. Is this microphone on the table in front of me, is this an artwork or it's purely a microphone? Well, right now in front of me, it's a microphone. If you see it on a pedestal in MoMA, under a glass box, it's an artwork. Would you be able to look at the object itself and distinguish whether it's an art or an ordinary object? In contemporary art, that's virtually impossible. So therefore, you cannot use performance measures to really see how well art does. It all depends on the context. And then you have to start developing other rules and tools and laws to describe how success emerges when performance is not measurable.
And I was fascinated by the difference between the two artists you talked about, Jean-Michel Basquiat and his partner, what was his name, Al Diaz. And their work, some of their works were virtually indistinguishable, yet we don't know, nobody knows who Diaz is, but lots of people know who Basquiat is, and his work sells for millions of dollars. What was the difference between the two of them?
I'm glad you kind of pointed that out. Indeed, for me, the Al Diaz and Basquiat example is a perfect example for what I would call the first law, is that when performance can be measured, networks drive success. And indeed, we're dealing with two artists who started their career together in the 1970s in New York. Not only they started their career together, but they really worked together under one single name, the name Samo, and they did graffiti art. And they did so for about a year and a half when they broke apart. And within 3 years, their trajectory completely diverged. Al Diaz is still alive today, working in the New York art scene. And if you haven't heard about him, there's a reason. However, Basquiat, 3 years later, paints a painting that became the most expensive painting sold by an American artist a few years ago. And so what's the difference? Well, fundamentally, networks. When you look at the career of the two individuals, Al Diaz approached art from a performance perspective to say, it's about making the right artwork at the right place. However, Basquiat immediately recognized that he has to embed himself into the community of artists in New York, and he befriended within a few months interval some of the biggest names of the art world, like Andy Warhol, and actually moved in and lived in Gagosian's apartment, who later on became, of course, today is the biggest art dealer out there. And so Basquiat has mastered the network that really mattered at that moment in the art scene of gallerists and other artists. Al Diaz, however, continued to approach art from a performance perspective as trying to produce more and more works. And of course, the difference is huge. And what we did is that, of course, the book doesn't only rely on anecdotes. I have had the possibility to get access, thanks to Magnus Resch, a gallerist in New York and an art historian in New York, to an exceptional data set that allowed us to track the career of every single artist in the last 40 years, both in America and abroad. 500,000 artists were in the database, and we could fully reconstruct their career. And what we found there, that in case of artists where performance is unmeasurable, there's a hidden network of institutions that could be mapped out with this data, and that network uniquely determined their success. And this was not only kind of a finding that that network determines their success, but we were able to turn that one into a predictive tool such that if you give me your favorite artist's name and the last 5 exhibits that he or she had, I can fast forward her career and tell you what level of institutions would actually be really exhibiting in 10 or 20 years from now. And the reason we can do so accurately is because performance is not measurable. All the predictive power is in the network. Where you are in the network, whom are you connected to, what is the prestige level of those institutions. So art is a perfect example of the first law of the formula saying when performance is not measurable, it's networks that determine success.
Now, I'd like to skip over, if you don't mind, the second law of success in your book, which is performance is bounded, but success is unbounded. And I want to talk about the third law, which says that previous success times fitness equal future success. Can you tell me, what's fitness? How do we define fitness?
Sure. And before we go to fitness, let's first talk about the previous success determines success. And this is a discovery that I made almost 20 years ago while we were studying the World Wide Web and trying to understand why do we have certain web pages like Google and Yahoo back at that time who had such an exceptional number of links from other websites, and why is my website hardly acquiring any links from outside individuals? And what we realized there is that the only way to explain mathematically what's happening and what drives the emergence of these hubs on the web is that success drives success. That is, the more links a certain website has, the easier it is to find it, and the more likely that it will actually acquire further links from other websites. And then we soon realized that this is not only unique to the World Wide Web, but in all areas where you have some measure of success is true. It's certainly true for money. People kind of end up acquiring money in proportion to how many they already had. If nothing else, that's what compounding interest is. But it seems to be true also for scientists of how they acquire impact, that the number of citations my papers get is proportional to how many they got in the past. Now, the problem with this rule is that it just simply says if you have a lot, you will get more. Well, how do you get a lot to begin with? And that's where fitness comes along, because we realize that there are differences between websites. Some websites like Google are acquiring links much, much faster than mine, not only because they have more links, but because they offer services that are more desirable to the public at large than, say, what my website offers. And so we named these differences fitness. Fitness is the node's ability to acquire more links, the person's ability to acquire more money, to earn more money, your ability to acquire more friends. And the way this works is that, how popularity determines how easy you are to find. But once I found you, it's your fitness that determines whether I want to link to you, whether I want to give money to you, whether I want to become friends with you, whether I want to write a paper with you as a scientist, and so on. So really, and fitness is unique to each individual, and it's not something that you as an individual determine, but it's something that the community assigns to you based on what you have to offer to the community. And this fitness is actually measurable in many contexts, like case of the World Wide Web, what's the fitness of the website? And therefore, we arrive to this third law saying it's previous success times your fitness that determines your future success. That if you have low success to begin with by high fitness, you will acquire links faster. And could be very, very successful that you have a high level of success, but for whatever reason your fitness drops, then you will actually stop growing and you will stop actually acquiring further links or further money and so on. And your growth will slow down.
So Laszlo, fitness to me sounds like it's another way in which you're saying this is the network's assessment of your performance or your fitness. They sound very It sounds to me like it's the network saying whether or not you're good enough, whether or not your performance is good enough. Is that accurate or no?
Absolutely. Yeah, absolutely. So it's a measure that the community assigns to you, and it's really a competitive measure, how much more attractive you are than the person next to you. And of course, this doesn't happen by simply comparing pair by pair people, but simply if you have a large community who's choosing between different individuals, between different services, before different songs, they, through their joint action, they slowly start assigning a fitness to each node. And that fitness, which it's not written on any of that, but it's kind of measurable, eventually determines their growth rate.
Right. And it depends on what the network is looking for. For example, if people like a good female singer to also be very pretty, a better female singer who isn't as pretty might not be deemed as fit.
Certainly, but also depends a little bit of what community are looking at it, right? So I'm sure that my parents' generation would assign a completely different fitness measure to a Britney Spears song than my generation or my children's generation, right? So the fitness is kind of incorporating this subjective judgment about whether I like it or not. But because so many people are voting on you, on the object or on you, at the end, there's a unique number that allows me to say how fast you would be growing in that particular environment.
One of the things that gets me about the emphasis on previous success, when I got to that point in the book, I was kind of depressed because I thought, well, I've had some success, but maybe not so much, let's say. But you give me hope with your fifth law, and I'm skipping the fourth one for now. We can get back to it. You give me hope with the fifth law because the fifth law is with persistence, success can come at any time, even late in life. No?
Oh, I'm so glad that you jumped there because that's really my favorite law. And let me give you some background.
Yeah, me too.
I just passed 50, and based on all the data out there, my chance of creating an innovation, writing a research paper that would overcome my earlier work, statistically is close to zero. What do I mean by that? Yep. It means that when you look at the career of high-performing individuals, there is overwhelming data to indicate that many people make their most important discoveries, contributions to society, to art, relatively early in their career, in their 20s and 30s. And this is so severe and so persistent that Einstein once claimed that a scientist who doesn't make his big discovery by the age of 30 will never do so. So the question we ask, well, that's certainly very bad news for me, because it suggests that really I should stop doing what I'm doing, which is running a lab and trying to make new discoveries and publish them. And maybe I should just write books. Sounds like you like my book. Maybe that is my next career, because the chances are of making a discovery that would be bigger than I did before is close to zero. Well, we were curious. Let's look at the data, and let's not only look at geniuses, let's look at everyone and ask ourselves, is it really true that only young people tend to be innovative? So we analyzed, for example, all the careers of all the scientists from 1900 to today in all disciplines, and we confirmed that that seems to be the case. That is, most scientists write their most important paper, whether that's a Nobel Prize-winning discovery or something that no one remembers 10 years later, right? They do so relatively in their kind of like, roughly 10 years from the beginning of their career, which is what we call the academic age. So we confirmed what the belief that was out there for a long time. But then we are data scientists, so we started looking a little bit more carefully at the data and look for the placebo effect. What would happen if I make my discoveries completely randomly? That is, what happens if any of the papers that I ever write could be the most important paper of my career? What happens if any of the business deals you put together could be the most important business deal for your career? What if it's completely random in the space of the deals, of the papers you write, and so on? And so we said, let's see what happens in the case of random careers. And to our surprise, we realized they were indistinguishable from the real ones. And to make this long story short, what we realized is that really what changes during the career is not the creativity, but the productivity. That is, young people tend to put lots of projects out, and as they age, the number of projects decreases. The people are not trying any longer. However, what we showed is that each project a scientist puts out has exactly the same probability to be the highest success project in his or her life. So a little bit, discovery innovation is like buying lottery tickets. Every lottery ticket has roughly the same chance of winning. But if you buy most of your lottery tickets when you're young, it appears that you have to be young when you win the lottery. And it appears that old people cannot win the lottery. So at the end, what the fifth law does is that it summarizes really this key discovery that we made a few years ago in my lab, that really innovation is not about age. Innovation is about persistence. And those individuals who keep trying can be truly innovative relatively late in their life. And my favorite idol in that space, an example, is what I discussed in the formula, John Flann. John Flann is a scientist who was a chemist, and he worked at Yale University. And at age 65, or 70 actually, he was forcefully retired by Yale University. This was kind of in the 80s, 70s and 80s, when there was still a retirement age. And he was still full of energy. So instead of actually retiring and leaving his lab because they closed his lab down, he moved on to another university, Virginia Commonwealth University, started a new research lab, and it was there where he published his greatest discovery of his life about electrospray ionization that 15 years later, at age 85, landed him the Nobel Prize in chemistry. And I don't think that John Flann is special. I think John Flann is just an example of an individual who simply believes that creativity doesn't wane with age. And he just kept trying and trying and trying. And he just actually passed away a few years ago at the age 90-something. And, 3 days before he passing away, he was still in the lab working on the next research paper.
So that's a message of great hope for me, because I'll be 60 in 3 years, and I really have no interest in slowing down at this point. And you're giving me a lot of hope that my efforts will not be in vain, because success could come at any time. But this topic is really good for investors, isn't it? Because, we buy a portfolio of stocks not knowing which one will be the best performer. If we knew that, we'd only buy that one. So we buy a portfolio because we persistently, change the portfolio over time, never knowing which investment will become our greatest investment. But the point is to stay in the game, to survive and stay in the game. It's a wonderful message.
Absolutely. And if I may add something to that, before you think that this is only something applies to scientists, think twice. Because after the formula was published, a colleague of mine, two colleagues of mine from Northwestern University and MIT have looked at the age effect for the founders of the startup companies. And if you want to think of one area where really youth really dominates, that's Silicon Valley, right? And the belief that you have to be in your 20s to start the next Facebook or Google. And, that's certainly to some degree true and held very closely by the community, because if you look at the biggest Silicon Valley awards, they all go to people in their late 20s or early 30s. And when you look at the major firms, the major 5 firms, and the age distribution of the founders of the company they support for the first time, it's late 20s, early 30s. So there's a deeply held belief that if you want to make it in Silicon Valley, you need to start early and you need to be successful early. Yet, what my colleagues have done is they looked at not only what age do they actually get these kids the investment, but they also asked, will they succeed? That would a company be sold as an IPO or be sold or get an IPO? So they measured success in terms of, is there a successful exit? And what they found is that, yes, a huge number of investments go to young people, but the success is not staying with them. And actually, a 50-year-old founder has about 3 times higher chance of having a successful exit than a 30-year-old founder. So yes, the belief is very strong, but it doesn't mean that it actually leads to success. And Silicon Valley is no different from the other areas of performance. You have to keep trying, and often the biggest successes really come relatively late in time. So yes, the Google founders were young, but they needed an Eric Schmidt to turn into Google what it is today.
Wow, that's great. I had never heard that before. Laszlo, we're actually towards the end of our time here. So I usually like to ask, if you could just leave our listeners with one thought about your work with success and networks. I realize it's asking a lot because you've done a lot of work and made a lot of discoveries. But if I asked you to leave them with one thought, what would it be?
The most important thing I learned from the formula is really that your success is not about you, but about us. That is that if you want to be successful, it's not enough to have performance. You really need to see how the performance is being achieved, recognized, and seen in the community around us. And to me, that's a very humbling experience because it really helped me understand that every decision I go for going forward, if I care about success in that particular domain, and you don't always have to care, but if you do care about success, you need to go outside of yourself and look at your community because they are the key to your success.
Don't hide your light under a bushel.
Absolutely. Thanks for having me.
Okay, Laszlo, thank you so much, and I hope we can have you on again someday. Are you working on another book?
No, after every book, I like to have a 4 or 5 year break. So yes, I am working on a book, but that's a much more technical book, not general audience. We're writing with my former student, Dashun Wang, a beautiful book called Science of Science that is really taking these ideas into the scientific place and rethinking how science works.
Okay, well, I guess we'll have to wait a few years for another book like the formula then. But it'll be worth it, I know. Thank you so much for being here, Laszlo.
It's my pleasure. Thanks for picking the formula to feature in your podcast.
Hey guys, real quick, I just want to tell you something. As host of the Stansberry Investor Hour podcast, I also enjoy listening to other podcasts. It helps me figure out ways to make the Stansberry Investor Hour a better experience for you. One podcast I really like is called We Study Billionaires, hosted by Preston Pish and Stig Brodersen of theinvestorspodcast.com. It's the biggest investor podcast on the planet, enjoyed by thousands of listeners every week. Preston and Stig interview legendary billionaires like Jack Dorsey, founder and CEO of Twitter and payments company Square, and billionaire investor Howard Marks, whose book, The Most Important Thing, I've recommended dozens of times. Sometimes Preston and Stig spend a whole episode reviewing lessons learned from billionaires they've studied, like Dell Computer founder Michael Dell, tech industry maverick Peter Thiel, and macro trader Stanley Druckenmiller. Before starting the We Study Billionaires podcast, Preston went to West Point and Johns Hopkins, founded an investment company, and his finance videos have been viewed by millions. Stig went to Harvard and worked for a leading European energy trading firm. They're smart, experienced investors who know the wealth-building secrets of billionaires better than anyone, and their listeners love it, and I'm one of those listeners. Head over to theinvestorspodcast.com and check out We Study Billionaires with Preston Pish and Stig Brodersen. Theinvestorspodcast.com. Check it out. In our next episode, which airs in January, I will, again, try to avoid doing what everyone else does by making predictions about the coming year. It's kind of silly to make predictions. What I'll do instead, it'll sound like predictions, but what I'm really going to do is I'm going to start out by figuring out what expectations appear to be baked into the financial market right at that moment. And then we'll try to figure out, based on that, what would the opposite thing look like? What would surprise the market in 2020? And yes, I got that idea from a guy from Blackstone named Byron Wien, who every year for 30 years or something, he's put out his 10 surprises for the coming year. But his surprises are really like predictions. And I'm not going to do that. I'm going to say, this is an alternative scenario that is not baked into securities prices right now. So I'm not going to predict, who's going to be the next president or things like that, like he does. I'm just going to do something a little different. I think it'll be a lot of fun, and it'll fulfill this part of our mission that I think has developed into a really good conversation with us about things that go against what you might believe, right? You're looking for alternative ideas. Maybe you're bearish like me. You got to look for things that would result in the market going up, right? And that goes for any view that you might have. Some people like to say that you should have a strong viewpoint loosely held. I definitely have a strong viewpoint, but it's kind of loosely held because I'm ready to be wrong about it. So that's what we'll do. We'll look ahead and we'll say, how could the market be wrong right now in 2020 as things play out over the coming year? I hope that sounds like fun to you. I'm really looking forward to it. And it's been a really great year for me here, thanks to you. Without you, this podcast is not worth doing. I'm really grateful. And, as tired as it's become to say this, I'm humbled by the many listeners who download and listen every week. Thank you very much for helping to give me a purpose in life. It is really, truly a privilege to come to you this week and every week. I know your time is precious. I'm thrilled that you've chosen to spend these weeks here with us, for an hour every week. So on behalf of podcast producer Justin Mattis and engineer Greg Baffitis, I thank you for listening. We have some really cool interviews lined up for the coming year, including some honest-to-goodness TV stars who probably know more about finance than a lot of people in the finance world. And we'll have that and a lot more in 2020. I hope you had a great 2019 and happy holidays. I will talk to you next year. Remember, go to www.investorhour.com and sign up, put your email in there, and you'll get all the updates, and send us lots of feedback, questions, comments, politely worded criticisms, and go to Apple iTunes, download Stansberry Investor Hour, give us a like. That'll push us up in the rankings and invite more people like you into the conversation, which is always a good thing. So I will talk to you next year. Bye-bye for now.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.